Just gonna wait to see if we pop up here. Okay, and it looks like we are live. All right, so welcome back everybody to lesson four of our Back to Basics program, where we're taking some people who work with trade ideas who have never traded before and never really explored the market, and we're kind of going from the absolute beginnings of trading all the way to hopefully advanced and showing some of our cool tools and things we can do with it there. So we are down someone, but hopefully Kelly comes in a little bit later. So just say hi to Shantae, Rudy, and Marissa. Everyone just wave. So one thing I'm going to start these lessons out with, when I remember, because I forgot before, was kind of what we did last time, and then questions. If you guys have any questions that you thought about within the week or anything that was going on there. So last time we talked about exchanges. We talked about basically how it goes from you hitting a button to send an order from your order platform over to your broker, what your broker does with it, and what your broker's responsibilities when it comes to AML and KYC and managing your money and holding the finances, as well as being a counterparty to make sure that trades kind of flow through easily, all the way to the exchange and how it's actually traded there. So that's what we did last time. So I'll just quickly, and I should have prepped you guys a little bit before, but was there any questions or anything that anyone kind of came up with throughout the week, or that was all good? So probably, let's just hope I'm doing a good job at explaining what's going on there. So from there, this week we're going to go into order flow. So we're going to go into exactly how kind of the market moves. So we talked about what a broker does and what an exchange does to make sure that trades are able to be conducted kind of as fairly as possible and in some sort of orderly fashion. And then at the end of that, we talked a little bit about order flow in level 2 and how that worked. So what we're going to end up doing is we're going to take that kind of to the next level and focus on that for this. So this is a concept that can confuse a lot of new traders. So I intentionally kept this short, and I hope that it spurs a lot of discussion. But if you guys get it right away, then it will be a fairly short lesson this time, which is good. The other thing I've done, and I'm looking at it on another computer here, is I've actually found a way to watch the chat. So we already have our first question in the chat. So I'm going to spend some time interacting with them at the same time as interacting with you guys. So I think that'll be a little bit cool thing to put in. So last week we talked a little bit about this, but I'm going to kind of pretend that we didn't and start again from scratch. I hope that helps you guys out. So we're just going to go some vocabulary, and then there's going to be some pictures and a little video that I recorded of the market trading, so you can take a look at that in not real time, but what it would look like if it was in real time. So quick vocabulary is just looking at a bid. So a bid is essentially, I'm always going to bring this back to the real world because it's just how my brain thinks, and I think hopefully these analogies will help you out a bit. Hello, Kelly. You're late for class. Detention will be later, but basically you didn't miss much, Kelly. We were just wrapping up what we did last week, and we were going right into the order flow and what we're doing here now. And this is the first slide of that. So that's great that you joined when you did. So essentially, we'll just go through these in order. So a bid is what someone is looking to buy a stock for. It's not a trade that actually happened. It's just what someone puts out there. If any of you guys have ever bought a house before, you know that they have a price out there in the market, and you always go in and you never go for that price. You always bid for a different price, right? So your bid, so say someone's selling a house for $300,000. You might go in and you might say, okay, I'm going to bid $250,000. Right? So there's a spread there between what the offer is for the person selling and what your bid is as the person buying. And that's the same in the market. So a trade will only happen when you finally agree on a price. So when we talk about a bid, we talk about people who are looking to buy the stock at, say $10. And then an offer or ask, depending on the platform, depending on where you go, sometimes they're treated a little bit different. That's what people are looking to sell at. So those two people will continue to exist with a little spread between them until somebody decides to take someone's offer or take someone's bid. And that's what would generate a last price. So we'll end up seeing that you can read the ticker tape, which shows you every trade that has taken place in order and the size and at what time it occurred. And that's because somebody has decided to either sell to someone's bid or to buy to someone's offer. Does that make sense to everyone so far? Again, questions, please chime in. I'm a rambler. So, and then size applies to all above, but it's just how many, right? I can go out there and I can say, our house example isn't a good example because there's just one thing to buy and sell. But with trading and with most stocks, there may be millions and tens of millions and sometimes hundreds of millions of shares a day. So not only do you want to know what the bid is and what people are trying to bid and what people are trying to offer, but the amount of each. Some guy might be bidding 100 shares, whereas someone else might be offering 10,000 shares. And as a trader, that might give you some clue of where the big money is or the smart money or whatever trading style you end up doing with it. But that's definitely part of the equation. The last thing that we'll talk about a bit is the NBBO, once this thing goes away, which just stands for the National Best Bid and Offer. And that just means that there's a rule in the market that says that all trading has to exist within the best bid and offer. So if, for example, if Rudy was trying to buy that house at $250,000 and I'm trying to buy it at $200,000, the seller can't go around Rudy, who has a better bid, and sell to me. It has to be whoever has the best bid at the time and whoever has the best offer at the time. And basically what this does is it just keeps things, I guess, quote unquote fair, but it basically makes sure that there's no funny business. Where there used to be in my day, one of the things that I used to do when I traded prop and I sat there before the computerization of the market, we would try to find a way to get around this rule. And sometimes there was opportunities where you could buy a stock at, say, $1 and instantly sell it to someone else at $1.10. And you didn't really know what was going on. It was just kind of a break in the system. So then they implemented this rule and they said every trade has to occur at the NBBO, minus some few exceptions that we'll talk about later. So
I'm sure you're probably going to show us, but you're probably going to do it on the next slide. Like, how are you communicating these bids and these offers and these like is this all via messaging or like, I'm kind of confused by that, I guess.
Well,
I understand the concepts, but how are we communicating these?
Well, and that's the beauty of, so when we went through the course, we said that was essentially the exchange's job is to keep all of these in order.
So you're paying somebody. Okay, I see.
Right. So the exchange, basically, it takes all of the different trades from all the different brokers out there. We used Interactive Brokers as an example, but there's hundreds of different brokers out there, and it funnels them in and then sorts them all in order. So it makes sure that if somebody is bidding a low price and someone else is bidding a higher price, that the exchange is a computerized system that makes sure that they all transact.
It's all automated. Okay.
It's all completely automated now.
Got it.
The days of the people with the funny jackets are sadly gone. I always had a bucket list thing where I wanted to go and wave my hands around and do a trade like that, but it's pretty much non-existent now, unfortunately.
Thank you.
No problem. I like questions. They stop me from just rambling incoherently. So this is essentially a level 2, and then over here is a time and sales. So we went through that vocabulary in the last thing where we said, okay, this is a bid, this is ask, and this is the last trade that happened, right? So right here, stuck in time, we can see this kind of in the real world. So this was General Electric yesterday, I think, because I procrastinate building these spreadsheets, but you can see here all of the bids are sorted right here, right? So you can see there's a guy bidding, and you take all these numbers here and you multiply them by 100. So there is 13,500 shares. Yes. That a guy is bidding. He's looking to buy those shares at $9.18. There's also a different guy who's bidding $9.18 for 8,000 shares, and so on and so forth down the line here. But these are all existing in one price. And over here, you can see there's a guy with 500 shares who's looking to sell at $9.19. And then there's another guy who's looking to sell another 500 at $9.19. So you can see these guys essentially have a disagreement in price, right? They will not transact with each other because one guy is bidding a certain amount and the other guy is offering a certain amount. So they're just going to sit there until somebody crosses the line. I'm just going to take us out of the shot for a second here. So then this is the tape, right? So this is essentially what has happened in the order it has happened. So you don't multiply these numbers. These are actual numbers the way they are. Essentially, if the number is red, it's saying that somebody has sold to this guy right here, right? Does that make sense to everybody? Somebody's come along and they've seen $9.18 and they said, okay, that's the price I want to sell at for whatever reason, right? You'll never know. It's free market economy. So they have sold to them, and you can see all of these trades as they went through, right? This guy sold 2,000 shares. This guy sold 2,700. This guy sold 5,000. But yet there's still more to go. Whereas, so this over here is a snapshot in time, right? This will change every second, which we'll show you in a video later. But this is an app. This is just a snap as it happens. This is kind of as time goes on. You can see that there's a couple seconds that go by between these trades. So one of them is, all right, I'm wanting to buy, again, I'm wanting to buy a house for $250,000, and the other guy's saying, I want to sell a house for $300,000. And then what's happening through here is it's basically showing you all the times that somebody's accepted a bid or accepted an offer and then made a trade throughout them. Right? So between these two things, what you can see from a stock is that where the people are looking to buy and where the people are looking to sell and where you would get filled, right? So if you wanted to go and buy this stock right now, you have two options. One is you put out a bid at $9.18 and you sit there behind all of these people in line, right? So regardless of how these things are split up, everything hits the exchange and it's put in a sequence. It's put in a line. Put us out right here. So yeah, everything's put in a sequence and it's put in a sequential order. So if you wanted to buy, you need to understand that, you wanted to buy your 100 shares, you're going to be behind all of this that has happened, right? Or if you want to buy, you can just buy from these people who are poised here to sell already. But it means when you want to buy, then instantly if you change your mind, you want to sell, you lose that penny, right? You always lose that price. And the main thing I want you guys to take away is that essentially what this is, the last price, this is what you see on a chart. This is what you see if you go to Yahoo Finance and it says Apple's last price was this. They're showing you the last time that something has changed hands between two people. That doesn't mean that's what you can get it at, right? You can either buy at this price or wait in line here and hope that enough people sell that your turn in line comes up. And if the stock moves up before then, you don't get filled, right? You don't get any. The other thing to keep in mind, and this is a little bit more inside and I don't think matters too much, is that there's different fee structures to whether or not you're the person sitting here in line or whether you're the person going and buying from the shares there. They call it the maker-taker model. And it doesn't really matter to us, but people like hedge funds and prop trading firms and this type of thing, they'll actually get rewarded for sitting in line, because what it does is it adds liquidity to the market, which we've talked about a few times, where it makes it so that investors can kind of come in and make a trade very quickly, right? So that's why people, because I always get that question, is why would you sit out there? Why wouldn't you just take the 1 cent hit and just go get your shares filled instantly? And that's because there's all of these systems in place to incentivize people to be sitting on both sides. So again, back in the day before the computerization of the market, that's one thing that we did a lot of in the prop firms, where people would sit and they would just make that money for adding liquidity to the market. So there was people out there who would, sit all day. They would try to get filled here, and then they'd try to get filled here, and they would make 1 cent plus whatever rebate they got for making that market. And that's actually a question that was asked in this in the chat below here. They basically said, what is the difference between an ECN and a market maker? So an ECN are basically these, you'll see ARCA, NASDAQ, EDGX, BATS. These are all traded on the New York Stock Exchange, but these are different ways into the New York Stock Exchange, and they all have their own fee structures. And that's why you would choose one over another, is depending on the fee structure. A market maker is a human being or a robot who is constantly adding liquidity to both sides of the market to make that spread. So I think a few weeks ago, Rudy, you asked a question of, what if you bought a stock and then there was nobody there to sell it to, right? All of this liquidity went away. And I said, well, we'll filter out stocks to make sure that you have some liquidity to them. What a market maker does is that's his job. His job is to make sure that you can fill your order when you want to, and in return, he gets to make that money on the spread. So I know this is really hard to conceptualize. So again, any questions?
I have
certainly.
A question.
Yep.
Maybe I forgot, but the 989, what is that?
989.
General Electric, $9.89.
Oh, up here, I believe this was yesterday's price.
Yes,
We might see in the next slide's kind of more the same. Yeah. Okay. So this was before the market opened, and this was when the market opened. So you can see it's saying that the last price that occurred was $9.47. And you can see that the last trade that occurred right here was $9.47. That makes sense? So this is a competitor software, so we won't worry too much about it, but it is kind of confusing. With trade ideas, we don't generally give a level 2 for reasons I'm going to talk about in another couple slides, but the other reason is that your broker gives you this. Pretty much every broker that exists has this information, and you get it just from doing business with them. So there's really no value add to come to trade ideas for this, which kind of exists here as well. So yeah, this I just wanted to show when the market was open, how things start moving quicker. So if I move over here, you can see all of these trades, because before it was just a sea of red trades. Now you can see some green and some red. And again, green just denotes that the last trade that happened, somebody came up and they bought from these people who are offering. A red trade just means they went down here and they sold to somebody who was bidding.
So
right?
then what are the, okay. So on the,
This is weird, so don't worry about it.
Well, the window on the left, there's red and green, and on the other window there was red and green and slightly variations of colors. One you had before that said 989, and I just wasn't sure what those colors meant.
They're basically just trying to signify whether these people are moving up or down. So basically, I would ignore the colors here. They're just ignore them for now. These colors are the ones that I want you to focus on, because you can start to train your eye. And again, another thing that happens a lot when you're trading is what you might do is I'm going to look to buy this stock, and then you bring up the level 2, and then all of a sudden, if you just see a whole bunch of green going through here, then somebody is willing to accept those extra higher fees that we talked about. Talk while I fix my camera here. Oh, my back. No. Yeah, so accept those higher fees, and they're willing to lose the 1 penny in the difference in order to get those shares, right? That's something that's interesting them enough that they're willing to kind of take that hit, I guess, lack of a better term, to end up getting those shares. Ooh. Yep. Now you get to see my wall. How good is that wall? There we go. So here, what I'm going to show you guys is this actually happening live. So what I did is I captured General Electric in the morning, and I captured it trading. So what I'm hoping is that we can go way down. So I'm going to slow this down, and that's as high as quality as I can make it, unfortunately, for this. So this is happening now live in real time, where you can see sellers coming through here, and as a seller prints, you can see that they're slowly getting taken away from this price. So what will happen is, in a perfect market, is that in 6,000, 8,000 shares, if you see 8,000 shares worth of red, what's going to happen is that this market would then move down 1 cent, right? Where all of a sudden, the 944 would end up getting taken. Right? But what we see is that these things aren't static, right? It looked for a second there, if we go back, that 144 was almost gone, right? There's only about 8,000 shares left there, right? So if we turn it back on, you'll see in just a second that, about 20, 30,000 shares just came back right away. I know my camera's being a bit weird, but we'll just ignore it for now. So you can see that even though it's kind of weird from a static point of view, that this thing is always moving. And by watching it, there's some information that can be gathered. For example, if you see, say, 1,000 shares end up getting sold, and there was 1,000 shares waiting there to buy, but all of a sudden, they come back like that. That may mean that there's a buyer there who's waiting for people to come sell to him, and then he's going to push the share price back up. And I know this is confusing. So what we saw there real quick, and it's real quick, is a tick down. And this is just what I want to show you how the market moves. So you can, let's go back to here. So you can see that there's 944 here on the bid, and then there's just a whole bunch of sells that come through, and then all of a sudden it's 933. So what happened there was everybody who was looking to buy at 944 got filled, and then the market moves down. So basically what I want you to grasp, because I don't, and for reasons I'm going to show you in a second, you're not going to be staring at this all day. This is not the thing that you're going to be making decisions off of. I saw a bunch of smiles. I think everyone's relieved. I don't look at this anymore. I don't think there's a whole lot of value. I'm just trying to teach you the mechanics of the market. How does a market go down? Well, it goes down when there's enough people there that are bidding for a price, and they get sold to, it pushes down, and then more people step in to sell at that price. Now you can see that the sellers are at 944, right? So it went from being the place where everyone was looking to buy to now the price where everyone's looking to sell. So that's how the market moves. It doesn't always have to be just 1 cent and 1 cent. And again, we're seeing a lot of red go through here as well, and we're seeing 930 or 943 starting to get eaten up. And then I think the video cuts off, but then it ticks down again, right? So there's this kind of misconception with new traders that the market moves based off of, especially you'll hear market makers and HFTs and, what have you. These are all the reasons why markets move. But as you can see is that for a market to move, there was hundreds of participants that took place there. There was trades just going through. So this 43-second clip, if you went through each and every trade, there's hundreds and hundreds that have happened in that 43 seconds. So what ends up happening is when people say, what is a market? It's kind of like a hive mind almost. Everybody is making these different bets and these different decisions, and kind of where the price lands ends up being what's going on there. So we'll go through questions, and again, there should be some of them anyway, I'd imagine, at the end of this, but why don't we use this anymore, right? Some people still do. I'm not going to knock anyone's trading style. I don't want to start a fight in any comments or anything. I don't believe it anymore, and it's because of these kind of three things. So the first is a dark pool. And what a dark pool is a dark pool is essentially a place where institutions, so if Goldman Sachs wants to trade with Morgan Stanley, they can do so without entering that equation at all. They can just, behind closed doors, kind of trade with each other, and that trade gets reported later down the road. So that's one reason, right? So, you know, you're already not seeing all of the equations that happen there. The other is they're called iceberg orders. So remember how I showed you how when that stock looked like it was going to tick down, all of a sudden someone put out another 30,000 shares to buy, which is roughly $300,000, right? The guy just wanted to buy $300,000 more of the stock. Nobody with the age of computers who wants to buy $300,000 or $3 million worth of a stock just puts it out there for everybody to see, right? If you think about that in, you know, that's the equivalent of in any game you ever play, you show people your cards, right? So imagine if you walked into that house, you again using the house example, and the other realtor was there, and you're just saying real loudly, man, this house is amazing. I would pay $400,000 for this $300,000 house. No one would ever do that. Or you wouldn't walk in and say, man, I really need to buy a house today. You know, I have to buy one. I have to buy one now, because you're going to get screwed on the price. And that's what happens in these markets now. So back when I started trading, before everything was so computerized, they would pay people to work those orders. And now it's all done with algorithms and you know, I'm sure you guys heard of HFTs and that type of thing. And that's basically what they're doing, is they're trying to hide how much they're looking to buy and sell. And then the last is order spoofing, which is essentially, you know, say on that General Electric thing, say I put out 250,000 shares to buy. I say, all right, I'm going to buy 5 million shares worth. That's going to scare the price up, because everybody's going to see that, and they're going to say, okay, well, I'm going to buy before this guy because there's some big desperate guy in here looking to buy. So what people will do quite often is they'll put out fake orders to move the price of the stock temporarily up and down. It is highly illegal. Don't do it. But it's like incredibly hard to track and prove, so it happens all of the time. So I'm sure you guys are going to be happy after this that I'm not going to recommend that you guys look at level 2 and you look at order flow, and that's how you make trades. We do most of that with technical and statistical analysis. Technical analysis is kind of what we're going to be talking about next. But I just wanted you guys to understand how a market moves. How when you see the last price at X and then you send your order to buy and you don't get that, why is that, right? And I hope that you at least have some understanding now of why, what the last price is and what your fill is going to be different, and you know what's going to happen when you need to go and buy and sell. Because I showed you GE where the price was 1 cent apart. We were talking before we aired about Chipotle. The spreads on that are going to be 50 cents to $1. So how I said if you're going to buy, you're going to instantly be down that 1 penny, because if you have to turn around and sell, you're going to sell it at a 1 penny lower price. On CMG, when you buy, you're instantly, if you want to get out right away, you're going to lose 50 cents. And that's, you know, the way that works. But so I just wanted, again, I hope that makes sense. You guys are kind of understanding how the market works, I guess, is the little bit we're trying to do here initially. And then I'll open it to question after this, but just a teaser, next week we're going to talk about charts. We're going to go through, and this is the first time I'm going to bring up trade ideas actually on the screen here. 5 weeks in, I'm sure the higher powers are happy with that we've given away all this content without even mentioning trade ideas. But so yeah, we're going to go over our charts. I'm going to talk about the basics of candlestick charts and why we use charts like that. And hopefully by the end of the next lesson or two, you're going to be able to look at this and understand what the hell's going on. So we're at time, but if there are questions, I certainly don't mind going over by a few minutes if you guys got the time. Anything? Bueller? Everyone confused, or did that all make sense?
I'm definitely going to go back and watch it later.
Okay.
It made sense. I get what you're trying to show us, how everything works. And I'm definitely excited for the chart reading.
Yeah, and I think that's how we all trade now. You know, it's the level 2, not so much, but go back and watch it. And then again, I'm going to do the same thing next week where I open up at the beginning to questions as well for last week's lesson. So if you have any, then you can ask them then. But if you have any questions,
you gives me a slightly better understanding, and your analogies help out a lot too. So keep up doing that. I appreciate it.
Perfect. I'm simple enough that's the way I enjoy doing it. So,
Yeah, I like it.
and I'm just looking at the chat here to see if there's any questions. And there was just one question about the hidden orders I was talking about, whether they will show up on the time and sales. I'm not exactly sure of the U.S. laws on this, but I think they have like 2 days to show up. So that's another reason, why we don't trust them very much. So
They're delayed, and you don't see them.
yeah, and that's, if you're looking at books to read, or if you're an Audible person like I am, you like to listen to books, there's one called Flash Boys, which talks about the computerization of the market and HFTs and how they're kind of hurting the little guy. It's definitely something to figure.
That's what I wanted to ask. I'm sorry. HFT.
Yep.
You said you guys know what that is, but I don't know what that is.
Okay, so quick thing is HFT stands for high frequency trading, and when you're in the trading world, it's demonized to hell, because essentially what they do is they're the guys now who are sitting on the bid and they're sitting on the offer all the time, and they're trying to make that penny spread. But what they'll do is because they're computers, if you go to put a large order into the market, they'll pull it right away, and they'll make sure that they don't get filled, and they'll offer it down a couple cents. So it gets to the point where, because it's humans competing against really high speed computers, that the humans always lose, which is why traders like myself and Steve and Andy and all these guys used to trade using that level 2 all the time. We've migrated away from it because we really just don't want to compete with Skynet, right? And that's why we built Holly and why we built Trade Ideas and all these things, because we wanted our own Skynet for the everyman, right? So, yeah, that's essentially it. It's just a really, really fast computer that's just kind of playing both sides of the market. And when everything gets hairy and the market starts moving and you think you really need that liquidity, they all just vanish. They all just turn off the bots entirely, and then you get these massive moves in the markets that hurt. Anyway, it's like it gets to the point where it's almost tinfoil hat wearing kind of ranting. But all right, so I think I'm going to wrap everything up there. Again, thank you. We got, I think, our biggest viewership so far, so we got a couple people that are paying attention, which is great. So thank you guys. I'll have the chat up from now on, so we'll be a little more interactive with that. And we will hopefully see you next weekend or next week at the same time. And stay tuned to Twitter, both at Trade Ideas, and I am at Bonpower, with this being my YouTube. I'll post something if for whatever reason we need to delay this because someone's going to be missing. So, all right, guys.
Cool. See you next week.
See you next week.